All right, let's jump right into this deep value investment analysis of the Canadian midstream energy infrastructure company, Keyera Corp. We're going to put this stock under the microscope today to answer one very specific question. Can this company hit our goal of a 300% profit over 16 years? To do that, we need an average annualized return of at least 9%. So throughout this explainer, we're going to unpack exactly what you need to know about Keyera to figure out if it actually belongs in your long-term portfolio. Here is our roadmap for today. We'll start with the business model, move into a financial deep dive, calculate intrinsic value and scenarios, evaluate the SWOT, risks and opportunities, lay out actionable buy and sell prices, and wrap up with the final verdict and takeaways. Section 1. Business Model, the engine of Keyera. To fundamentally understand Keyera, you really don't need to be some oil and gas speculator trying to guess the daily price of a barrel of crude. Nope. You just need to understand how a toll road works. Keyera operates essentially like a giant toll road for the Canadian energy sector, just, without the annoying traffic jams. Instead of making money off the wild, unpredictable swings in commodity prices, they generate revenue through recurring fee-based contracts. Producers literally pay Keyera a fee to use their infrastructure, and that creates these incredibly stable utility-like cash flows that are way more resilient to economic volatility. Think of their operations like a massive interconnected plumbing system. They gather natural gas right from the producers, they process it into usable products, transport it through extensive pipelines, and finally store it in specialized facilities. By linking all these parts together, they've built a multi-billion-dollar infrastructure network right in the heart of Western Canada. The big takeaway here, as long as Western Canada keeps pumping out hydrocarbons, especially with the huge expansion in LNG exports we're seeing, this network remains absolutely essential. Section 2. Financial Deep Dive. Auditing Keyera's health. Let's open up the hood and see what we're working with. Starting with their competitive advantage, or economic moat. It's definitely moderate. On one hand, Keyera has a massive defensive shield because building pipelines and processing plants requires billions in capital and years of grueling regulatory red tape. Plus, their geographic positioning is fantastic. But on the flip side, they just don't have the sheer and penetrable scale of industry titans like Enbridge or TC Energy. They're a highly relevant player for sure, but they aren't the biggest fish in the pond. Looking at profitability, things get pretty exciting. We're seeing a really strong 15.45% return on equity. They also pulled in a trailing 12-month EBITDA of nearly 1.2 billion Canadian dollars on about 6.85 billion in revenue. What this tells us is that Keyera is a highly efficient, mature business. They aren't in some crazy hypergrowth phase, but they are an absolute cash-generating machine. But hold on a second, because we hit a pretty major speed bump when we check the balance sheet. Keyera is carrying a seriously high debt-to-equity ratio of 228%. To put that into perspective, that is $6.3 billion in total debt against just $2.76 billion in equity. Now, heavy leverage is pretty standard for infrastructure companies since their cash flows are so predictable, but this level of debt significantly amplifies both returns and risks. And in a high-interest rate environment, those borrowing costs can seriously eat into their profits. So, bringing the rest of our audit together, we've got a competent, shareholder-friendly management team that smartly avoids diluting shares. Free cash flow is sitting at a healthy $492 million. However, there's a 112% accounting dividend payout ratio. That basically means they're paying out more than they're currently earning on paper, which is definitely something we need to keep a close eye on. Ultimately, the market is pricing the stock incredibly efficiently. Everyone sees it for what it is, a stable, yield-generating business. There's no obvious, screaming bargain here. Add in red flags like rising debt and recently declining free cash flow, and it becomes crystal clear that this is strictly an income-oriented play, not a deep value growth opportunity. Section 3. Intrinsic Value and Scenarios. Pricing the asset. Okay, let's run the actual valuation models and see what this toll road is fundamentally worth. By blending a discounted cash flow model with a multiple of enterprise value model, we land at an average intrinsic value of CAD $49.25. Compare that to the current price of roughly CAD $51.50, and you can see the stock is trading just slightly above fair value right now. There is very little margin of safety. That being said, the PEG ratio, which adjusts the PE ratio for growth and dividend yield, sits at 0.96. Anything under 1.0 tells us that the very attractive 4.23% dividend yield is actually providing some solid valuation support for long-term income investors. Now, if we factor in the broader macro environment, the future could play out in a few very different ways. In a bear case, think recession, stubborn interest rates, and weaker volumes, the intrinsic value drops to around $40. Our base case, which just assumes normal, stable Canadian natural gas growth, anchors right around $48. But the bull case? If we see a massive acceleration in LNG exports and falling interest rates, this stock could easily push past $61.
Section 4. SWOT, Risks, and Opportunities. Weighing the balance.
Let's distill all this data into hard, objective numbers so we know exactly what kind of risk we're taking on. The overall risk score lands at a moderate 6.1 out of 10. Basically, Keyera is way safer than a wildcat commodity producer whose fate is tied to crude oil swings, but it's a bit riskier than a pure, highly regulated utility company because of that heavy leverage and macro sensitivity. On the flip side, the opportunity score clocks in at a respectable 6.4 out of 10. This is driven by their fantastic unit economics, recurring revenue, and that solid geographic moat we talked about. But it is held back by the fact that the stock offers very limited valuation asymmetry. You're basically paying full retail price for that quality. Bringing it all together into a weighted swap analysis, Keyera scores a 6.1 overall. The strong infrastructure assets are doing the heavy lifting here, pulling the score up with an 8.0, while that high leverage acts like an anchor, dragging it down with a 4.0. This really just cements Keyera as a stable, middle-of-the-road, long-term play.
Section 5. Actionable buy and sell prices, the blueprint.
Here's the payoff. Let's translate everything into highly actionable price targets, based on our initial goal, a 9% return over 16 years. If you're targeting that 16-year horizon, the math is clear. To hit our 9% annual return and grab that 300% total profit, we absolutely cannot pay more than CAD 42 per share. It's really that simple. If you buy at the current price of around $51.50, your expected long-term return drops closer to 6.5%. Now, what if we keep that 9% goal but shift the time frame? If you only have 5 years to invest, you're going to need a much steeper discount, meaning your maximum buy price drops all the way down to CAD 34. The longer you're willing to hold this dividend-paying asset, the more wiggle room you have on your entry price. And for those of you who already have Keyera in your portfolio, here is your playbook. Look to start trimming your position and locking in some gains when the price hits the $60 to $65 range. If it rallies up to 68 or 72, you want to trim aggressively. And honestly, sell out entirely if it breaches $72, unless you see some massive acceleration in the underlying business fundamentals or LNG catalysts. Section 6. Final verdict and takeaways. So after digging into the toll road model, auditing that heavily leveraged balance sheet, and modeling out the valuations, where does that leave us? The core takeaway is this. Keyera is a genuinely good business. It offers an attractive, well-supported dividend. But right now, it lacks a real margin of safety. You are paying a premium for that stability. If you own it, hold it and collect that yield. But for new buyers looking for serious capital appreciation to cross that 9% hurdle, patience is your best friend. Wait for a sector sell-off or a recessionary dip that brings it below CAD 42. Ultimately, the big question for Keyera isn't whether it's a good company. It is. The real question is whether the incoming tidal wave of Canadian LNG exports can outpace the friction of these higher interest rates. This kind of deep dive analysis is exactly what it takes to invest with true confidence and avoid overpaying for great companies. It's the difference between just hoping for a return and actually engineering one. So I want to hear from you down in the comments. What is the next stock you want me to dissect in our next explainer? Let me know, and I will see you then.